Well, good afternoon, everyone, and welcome to our webinar, Unlocking the Power of Long-Term Care Insurance. This is our third webinar in a series we're titling Beyond the Portfolio. Last week, we heard from Annalie Kruger of CareRight, and she talked to us about how families can navigate the complexity of aging and caregiving. And the week before that, we talked with Medicare expert Jamin White. And if you missed any of these sessions, they're on our website under the webinar tab. You're welcome to go back and listen to them or share them with a friend or family member. And we will be recording this session as well and should have it up on our website sometime later tomorrow. Along the way of the program, if you have questions, please put them in the chat box or the Q&A box, and we will get to them during the Q&A session. So now I'm very excited to introduce our guest, Scott Olson. Scott has specialized in long-term care insurance since 1985. And he is the co-founder of LTCShop.com, LTC standing for long-term care, where he helps consumers navigate the various products and services that are available to plan for long-term care. He's also the author of the book, Simple LTC Solution, How to Protect Your Savings with a Long-Term Care Partnership Program. I've read the book, it's great. I think you'll enjoy it as well. Now, I can't stress enough how important the topic of long-term care, especially long-term care planning, is. Approximately 70% of the people age 65 and older are going to require some form of long-term care. And as we learned from our speakers the past couple of weeks, Jamin and Annalie, Medicare will not likely cover all of our long-term care needs. And at the very least, it may not cover them in the way that we would like. Okay, yet only 7 to 10% of Americans actually have long-term care insurance, which is incredible when you figure that if you're in a fully engaged long-term care event, it could cost $125,000, $150,000 a year for that in-home care. So at Century Management here, we regularly see significant financial impact that long-term care insurance can have on a family, because when we stress test a client's financial plan that we put together for a long-term care event, what we often find is that many times there is enough financial resources to cover the long-term care needs of the spouse that needs the care, but many times then there's not a lot of resources left over for the surviving spouse. And then there's a risk of what will their care be like, and or maybe running out of money. So this is a really important topic to understand, because this is one of those things with really good planning, you can avoid maybe an unpleasant scenario. So I personally have a long-term care insurance policy. I bought it through Scott, and I encourage you to do the same or have us put in the plan and we can work through that. But right now, I'd like to turn the floor over to our resident expert here, Scott Olson. So Scott, welcome to the program.
Thank you, Scott. I appreciate it very much. And let's see, let me figure out how to share my screen here. Here we go. Let's see. Go to that one. Sorry about that. Can you see my screen?
Yes.
All right, super, good. Thanks a lot, Scott. Appreciate it so much. And let me just point out a little bit of what I want to get accomplished today. All right. The most important part of today's webinar is this part right down here, the Q&A. Okay. I don't know what you don't know. Okay. So I don't know what questions you really need answered. I'm going to do my best to answer the questions in the next 30 minutes or so, trying to tell you everything that I think you need to know, or that I think, but I'm sure you have tons of questions that I won't touch on during the presentation here. So please take advantage of the chat box. Put your questions in there just as they come to mind. You don't have to wait to the end. You can start putting the questions in right away. And then at the end, I'll be answering each of those questions. I don't care how long it takes, as long as Scott's willing to keep the webinar going, I'll answer all your questions. All right. But there's 3 questions. Start right here. There's 3 questions that everybody always asks about, and I'm going to answer all 3 of these questions today during the presentation. First one is just, what is the average length of stay? Everybody always wants to know that. Okay. What is the best age to purchase long-term care insurance? And how much does long-term care insurance cost? That's the $64,000 question. Not literally, but it is. Okay. Now, just to add a little bit to what Scott was talking about with my background, I've been a licensed insurance agent actually since 1995. Scott said 1985, but it's actually 1995. And 1995 was a long time ago, all right? You know what was going on in 1995? We had the OJ trial going on in 1995. Right? We had, oh, look, who was in the White House? Bill and Hillary were in the White House, okay? That's their Christmas photo from 1995. But here's my favorite thing about 1995. You ready? Okay. Do you remember this? Okay. Every week I'd get one of these in my mailbox, okay? Trying to get me to get onto the web, whatever that was, okay? I had no idea. So 1995 was a long time ago, and a lot of things has changed since 1995, and most things have improved. You know what has improved since 1995? Long-term care insurance has improved a lot since 1995, and we're going to be talking about that. Just a couple of other important things just about me. I'm licensed in all 50 states, okay? So no matter where you live, I can help you or help a relative or a friend get long-term care insurance, okay? I'm also, I only do long-term care insurance. Now, I'm licensed to sell disability insurance. I'm licensed to sell Medicare supplements. I'm licensed to sell medical insurance, but I don't do those, okay? I only focus on products that'll help pay for long-term care expenses. And it's because the market is so complex, it does require that kind of specialty. Now, I sell traditional long-term care insurance. That's, in most cases, the best overall value. But there are other types of long-term care insurance as well that are linked with life insurance or that are linked with annuities. And we're going to talk about those in a little bit. But the most important thing is to understand that I'm an independent agent, okay? I don't work for any particular insurance company. I don't have any particular quota. I'm an independent agent, and I help people shop around for long-term care coverage in the variety of ways that it's offered today, okay? That's why in 2009, my wife and I called our website LTCShop.com. Now, currently I work with 13 different insurance companies, all right? And with those 13 different companies, there's 23 different products that they offer to address the long-term care need, okay? So there's lots of options, lots of variety, lots of ways to solve the long-term care planning problem, okay? And that's what I aim to do is for each client, help them find, I try to be a matchmaker. I need to buy the website ltcmatchmaker.com because I kind of make a match. I try to make the perfect match, right? With the each individual client and which product is going to be just right for them. So as Scott mentioned, in 2018, I wrote the book Simple LTC Solution. And it's all about how to protect your life savings from a special type of long-term care insurance called long-term care partnership policies. And we'll talk a little bit about those. And earlier this year, in the first quarter, I published another book called Long-Term Care Insurance Now. Okay? And I entitled that because so much has changed in the long-term care insurance industry over the last 5 years. You wouldn't believe it, okay? It has changed dramatically. There's been huge improvements to the policies offered now. And So that's why I wrote that book. And it's not, you can find these books on Amazon. They're not quite 5 stars, okay? It's close to 5 stars, but not quite 5 stars. But you can check that out and maybe leave a good review. And again, like I mentioned, my wife and I in 2009, we started the website LTCShop.com. It has thousands of pages of educational content to help people who are considering long-term care. Now, let's go to this, what's most important. What is long-term care, okay? And I'm not gonna bore you with the Medicare definitions and all that stuff. I'm gonna tell you 2 stories. One story about Joe and one story about Joyce. Joe was my first wife's father, okay? That marriage ended in divorce, okay? Partly due to the caregiving situation, right? And Joyce was my second wife's mother, okay? And so let's talk about Joe first. It was Thanksgiving, 1996. I had been a licensed insurance agent for about 1 year, and I was just specializing in long-term care insurance, and went to Joe's house for Thanksgiving. And of course, we talked about work. He was a florist. He talked about his work. I'm an insurance agent. I'm going to talk about my work, right? And I asked him, I said, Joe, do you have any long-term care insurance? He said, what's that? I never heard of it. So I told him what it was. And after I finished telling him what it was, he looked at me and he said, that's never going to happen to me. Well, conversation over. What am I going to do? He's my father-in-law, right? Well, about 17 months later, we get a call from one of his daughters, and she says, Dad came home from work last night, sat down at the dining room table to eat his meal, and he fell over and had a massive stroke, and he's in the hospital now. And Joe did have a massive stroke. He was completely paralyzed on the left-hand side. And he went to the hospital. He spent about a week in the hospital. Then he went to a skilled nursing facility for speech therapy and for physical therapy to try to get him back to where he was. But it didn't work, okay? He did not recover from the stroke. And he spent about 60 days in the SNF, SNF, that's short for skilled nursing facility. And then he came home, okay? After 60 days in the skilled nursing facility, the nursing home administrator asked his wife, well, Medicare is not going to pay for his care beyond day 60. How are you going to pay for his bill every month here from the nursing home? So his wife said, well, how much is it going to cost every month? And the administrator told her what it would cost. It was thousands and thousands of dollars. This is back in 1996, or sorry, 1997, and 1998. Sorry. Okay. So it was going to be thousands of dollars, and she said, "Well, for that price, I'll take care of him myself at home." Well, she really had no idea what she was talking about, because she herself had heart problems. She had insulin-dependent diabetes. She was overweight. There was no way for him to care for him, so she had to bring care into the house. Now, Medicare paid for someone to come to the house and give him speech therapy because he had trouble swallowing, okay? Medicare even paid for somebody to come in for physical therapy, okay? But Medicare did not pay for any of the care, what's called personal care, okay? Help with bathing, dressing, transferring, which means getting out of a bed or chair, toileting. Medicare didn't pay for any of that, okay? And at one point in his 7.5 years of care, we did move in with Joe, and we helped take care of him. I was the nighttime home health aide, and we had a daytime home health aide who was there from 8 a.m. to 8 p.m., okay? And the home health aides, Medicare did not pay a penny for them, okay? Medicare did pay for a wound care nurse to come to the house when he had a bed sore, okay? Medicare even paid for a podiatrist to come to the house to clip his toenails because he was diabetic. Okay. So Medicare paid for all that, but Medicare did not pay a penny for his personal care, for help with bathing and dressing and toileting and transferring and such. And personal care needs to be paid for from personal assets. And basically, Joe and his wife were forced to spend down their entire life savings, including all their home equity, until they had about $3,000 worth left in their accounts. And that's when Medicaid kicked in and Medicaid started to pay for their care. But Medicaid usually has very limited choices, and they had to be in a Medicaid-funded nursing home at that point. So Joyce is a little bit of a different story, okay? When I first married Carolyn, within about a year after we got married, her mother bought a long-term care insurance policy, okay? And it's fine. She just paid the premium, paid the premium every month on automatic draft. She had a special account that would have her Social Security deposited into that account, and then they take the money out to pay for the long-term care premium. And she just paid that premium every month, month after month after month. We didn't even think about it. We just forgot all about it. Okay. And then my wife and I left Southern California. We moved out of California to get out of the heat and get away from the taxes. Okay. So, and we moved up to the state of Washington. But when we left, my wife said to her mother, "Mom, if anything happens, I'm just a short plane ride away. Okay. If anything happens, I'll be right here to help you." Well, we moved up to Washington 2016. 9 months later, we get the call. Okay. It's from her brother. And her brother says, "Mom's slurring her speech." We took her to the ER and they had a CAT scan and turned out that she was having little brain bleeds. They called it cerebral amyloid atrophy, CAA, and causes dementia and it causes balance problems. And she needed care. Okay. She was cognitively impaired enough where she needed somebody to assist her. Now, Medicare, where she was actually on TRICARE, okay, because she and her husband were retired military. TRICARE for life. It's like Medicare on steroids. It's the best thing you can get. Okay. And TRICARE paid for the hospital. It paid for the doctors. She didn't have to go to a skilled nursing facility, but if she did, it would have paid for it. Okay. It paid for in-home therapy. She needed some physical therapy and some occupational therapy, and it paid for all that. It even paid for hospice when she was on hospice. Okay. But TRICARE for life, even though it's so good, didn't pay a penny for her personal care. Didn't pay anything for bathing and dressing and toileting. But again, fortunately, she had her long-term care policy. So we activated the policy. And instead of Joyce having to spend down her assets month after month after month paying for her long-term care insurance policy paid for her care. And her assets actually increased significantly. Okay. And we'll talk about that in a minute. But Joyce needed care for 4 years. And for most of that time, she was in an assisted living facility, not that far from our house in Washington. And for the last 8 months, she actually was living with us due to COVID. Okay. Now, let me just tell you what long-term care is not, okay? Long-term care is not end-of-life care. This is my favorite slide, and if I get emotional, I'm sorry, okay? This is my favorite slide because all of these pictures were taken when Joyce was on claim for long-term care. She was on claim receiving benefits from her long-term care policy because she needed help with bathing and dressing. But you know what she did? Those 4 years, she got to see her eldest granddaughter get married in Santa Barbara, California. Okay. She got to see one of her grandsons get married there in Washington. Okay. She spent 2 days a week visiting us at our house. Okay. Spending the holidays with us. Look how happy she is. Okay. Look at the smile on her face. She'd come to our house. We'd pick her up and bring her to her house twice a week. And she would spend the afternoons with us and have dinner with us. And you know what? She'd sit on her favorite chair, okay? And the cat would sit on her lap right by the fire, and she'd read her favorite book, okay? And she had friends that she'd go to the coffee shop with and have dinner with. And she lived a full life. So just because someone needs long-term care, oh, I gotta show you this one too. Okay. That's me. Okay. She liked fried chicken. Okay. So we would go out and we'd get Kentucky Fried Chicken together. Okay. And eat the chicken. And here she is drinking a root beer float. This was about 2 or 3 months before she passed away. And we didn't know she was that close. But even this one right here, one of her grandsons joined the Navy. And because she was retired military, she was in the Air Force, they took a picture of her. You can see she's in a wheelchair. And they took that picture at his swearing in to go into the Navy. But long-term care is not end-of-life care. Just because someone needs assistance doesn't mean their life is over. It's just a different phase of life. And you can still enjoy life and still love and be loved, regardless of the fact that you need help with bathing and dressing. Okay. Now, so what's the average stay? I promised I'd tell you, I'd answer that question for you. Well, there's a statistic on the internet. It's a government website. It says and it talks about males and females, but I'm just showing the male. It says for an average male, the average time of care is about 26 months, or about 2.2 years of care. There's only one problem with this statistic. There's not enough statistics to really justify that. Okay. Did you know that for every 9 people who need long-term care, only 1 of them is in a nursing home? 7 are getting their care at home, and the other 1 is getting their care in some other alternative facility, like an assisted living facility. So hardly anybody who needs care is getting their care in nursing homes. Most of us who need care get our care at home, okay? But there's nobody really tabulating all of those statistics about home care. Nobody ever asked me how long I took care of my first father-in-law at home. It was for 18 months, but nobody asked me, so there's no statistic about that, okay? And he needed care even longer than that. But so there's no real statistics about how long about everybody needs care. There's some statistics, and they're incomplete. But even more importantly, when you talk about averages, if we had a male number 1 needs 6 months of care, male number 2 needs 7 months of care, male number 3 needs 8 months of care, and male number 4 needs 7 years of care. You average those together, you know what you get? 26 months, 2.2 years. Okay. So my question to all the males listening right now, okay, are you male number 1 or are you male number 4? Right? We don't know. Okay. We don't know. Averages don't really help. When I look at all the members of my family who needed care, okay, 2 didn't need care at all. 2 needed care for 4 years, okay, and 1 needed care for 7.5 years. Another one's needed care for 9.5 years, and she still is receiving care. So you take all those averages. My family averages about 3 years of care, 3 or 4 years of care. But it doesn't matter. Are you the 0 years of care, or are you the 9.5 years of care? Okay, we don't know. Okay, we just don't know. So, this is an interesting little chart, but I just want to tell you, let's just talk about the financial benefits of Joyce's long-term care insurance policy. Okay, because She paid $40,000 worth of premiums over that 11-year period, but before she needed care. Once she started to need care, her premiums stopped. But so she paid about $40,000 worth of premiums. Okay. And that $40,000 of premiums turned into $280,000 worth of benefits that she received over those 4 years. Now, she could have, her policy had about 360 something thousand in it. That's what she had purchased. So it did have it was going to end, okay, but she passed away before she ran out of benefits. But that $40,000 worth of premium turned into $280,000 worth of benefits, okay? But overall, it improved her balance sheet, okay? If you're an accountant, okay, you know what a balance sheet is, right? If you're a financial planner, you know what a balance sheet is. It improved her balance sheet by $878,522. That's crazy, right? Well, here's why, okay? Their original plan, Joyce and her husband, Elliot, their original plan was that if one of them needed care, they would start to sell their rental properties, okay? Well, guess what? If they had sold those rental properties, they would have incurred $200,000 in capital gains taxes. That's a lot of money. Well, that's California for you, okay, for one, okay? But there's a horrific capital gains tax in California, as well as the federal capital gains tax. $200,000 that they avoided because they did not have to sell those properties to pay for Joyce's care. Well, when Joyce was in the assisted living facility, the long-term care policy paid the full cost of the unit. It also paid for all of her care expenses, and it paid for the food expenses. The only thing it didn't pay for was the food that her husband ate, okay, his food bill. So he had to pay for that. But she was cash flow positive. Every month, she was getting thousands of dollars in extra cash from pensions, Social Security, and from rental income. And so we took that money and we invested it. We put it in equities, mutual funds, okay? And it grew over that time because since she didn't have to sell those properties, she was able to invest the monies. She didn't have to use her own income to pay for her care. The policy was. Now that money that we invested for her, it grew. Okay, between stock and between dividends and appreciation, she earned 129 grand on that. Okay, that's not bad. Okay, and one of her rental properties had $185,000 increase in value over that 4-year period of time. So her largest rental property grew, appreciated over that time. Okay, and as you probably know, or when someone dies with real estate, the capital gains goes away, basically. Okay, if someone dies owning some real estate, whoever inherits it can sell the property right after that and not incur any capital gains. It's called a step up in basis, and that's what we did. We saved about $51,000 in capital gains taxes because of that as well. So there are the biggest advantages to long-term care insurance are emotional, okay, and familial, okay. The biggest advantage is that my wife, in handling her mother's affairs, didn't have to have any conflict about how to pay for the care with her brothers. Okay? All three of Joyce's children were understood that there was a policy in place and that was going to be used to pay for her care. And it avoided that. But clearly there's also financial advantages, huge financial advantages to owning long-term care insurance. We unlocked the power of Joyce's long-term care insurance, Scott, right? So there's types of long-term care insurance. There's three main types of long-term care insurance. First type is traditional long-term care insurance, okay? Often called standalone, okay? There's also what I call easy to qualify for long-term care insurance, okay? And there's asset-based policies as well. And we're going to look at all three of these. We're going to talk about the advantages and disadvantages of each, and then we're going to show actual costs of actual policies, okay? So traditional long-term care insurance, it's been around since 1974. It's been around a long time. Currently, there's over 6 million policies in force. All right. And so far, the insurance companies have paid over $150 billion in long-term care insurance claims. That's billion with a B. It's a lot of money. Okay. Every year, over 300,000 policyholders make claims on their long-term care insurance policies. And again, I said the first ones were sold in 1974. However, there's been huge improvements to long-term care insurance policies. In 1993, 1996, there are some federal changes in 96, 2000, more changes, 2005, more changes, huge improvements. But the improvements were not retroactive. So somebody who bought a policy in 1987 did not get all those improvements in 93 and 96 and 2000 and 2005. Okay. Now, I'll give you an example. I was talking with somebody on the internet not too long ago, and she said, I will never buy long-term care insurance. We were chatting on a forum. She said, I will never buy long-term care insurance. So I typed back, how come? And she said, well, my father had a policy and he paid premiums for years. And then when he needed care, it didn't pay a dime. So I said, well, why didn't it pay anything? And she said, well, he wanted to get his care at home, and his policy would only pay care if he was in a nursing home. And that's why I'll never buy long-term care insurance. So I said to her, I bet you that your father bought his policy before 1993. And she said, how'd you know that? He bought it in 1989. I said, because he had a nursing home only policy, and those policies were rarely sold after 1993. Okay. So she was looking at a policy that was really old and really lousy, okay? and based upon that, she didn't want to look at today's much improved policies. But so the improvements have not been made in the older policies, but every policy purchased today has all those improvements in it. Every policy purchased today has, or in most states, not every state, but in most states, you get all those improvements that were made in 93, 96, 2000, and 2005. So what about an easy to qualify for policy? There's lots of different names for these. I call them in my book, my new book, I call them recovery policies, but most people in the industry call them short-term care policies, only because they have a limited amount of benefits, much smaller benefit amounts than traditional long-term care insurance. Most of the policies out there that are easy to qualify for policies are horrible, terrible, lousy. Okay? They're bad. Okay? There's really only about 4, maybe 5 companies that have really good, easy to qualify for policies. And how many are available depends upon your state, okay? Because not every state approves these policies. But so there's a lot of bad ones. So you have to be really careful when you're looking at these. But the 2 most important things to look for are home care benefits, how rich the home care benefits are, and how do you qualify for the benefits? How disabled do you need to be? How ill do you need to be in order to qualify to receive the benefits from the policy? That's what you need to look for, and that's what's most important. Lastly, asset-based policies. What are these? Asset-based policies, they're called asset-based because they are assets, okay? They have either they have a death benefit, okay? So if you never need care, there's there's a death benefit that's paid to your beneficiary, okay? Or you can even cancel the policy if you want to and get back some of your premium, maybe most of your premium. In some cases, you'll get back all of your premium, okay? Some cases, you'll get back all of your premium plus interest, okay? So, so these they're called asset-based policies because they are indeed assets. But again, there's a lot of not so good policies like this, okay? Right off the top of my head, I can think of 5 companies that have really good asset-based policies, okay? But there's a lot that are horrible. In fact, for about every 5 of these policies that are sold, 4 of them are not very good, okay? But the key is, and if you're looking at these asset-based policies, make sure everything in this box right here you're looking for. Does the policy have a 7702B rider? What the heck is that? Okay, Scott, stop talking insuranceese for me and just tell me in plain English. Well, 7702B rider is the Internal Revenue Code definition of long-term care insurance. So if there's a life insurance policy and it does not have a 7702B rider, then it's really not long-term care insurance. You got to buy one that has a 7702B rider. So take a picture of that screen if you got your camera on you. Okay. Also, it's guaranteed to make sure that the policy is guaranteed to remain in force until age 100 or more. Okay. And lastly, make sure that the long-term care benefits are much bigger than the death benefits. A lot of these policies, here's the death benefit, and that's how much it would pay in long-term care benefits. But that's not a good idea, okay? If you're buying this for long-term care purposes, you want the long-term care benefits to be much higher than the death benefit. So keep that in mind. Okay. All right. And let's go to the advantages and disadvantages of each type of policy. So traditional long-term care insurance, but again, what I call standalone long-term care insurance, is the biggest advantage to traditional long-term care insurance is the cost. Okay. Traditional long-term care insurance usually, not always, but almost always has the lowest premiums, the most bang for the buck in terms of long-term care benefits. Okay, so usually has the lowest premiums. Also, it has lots of policy designs, lots of choices, lots of ways to fit and customize that policy to your specific needs. And also, like I mentioned before, traditional long-term care insurance can also be what's called long-term care partnership, which means that if you run out of benefits, you can still protect your assets from Medicaid. Now, the biggest disadvantage to traditional long-term care insurance is the underwriting. It's hard to qualify. Okay? Half of the people who call me asking for long-term care insurance, or half the people who call me and say they want to buy long-term care insurance, can't buy it because of their health. A lot of people wait until they have a health problem before they start to look into long-term care insurance. So they call me up and they say, Scott, I want traditional long-term care insurance. And I say, based upon your health history, you can't get it. Okay. So that's the biggest advantage, but the key is to apply for a policy before you have significant health problems. Now, like I said, there are the easy to qualify for policies. The biggest advantage to an easy to qualify for policy is, guess what? It's easy to qualify for, right? It's easy to qualify for it. Usually you just have to answer about 10 or 12 health questions and do a prescription drug check. And voila, you're approved. We get most of these policies approved in 48 hours, okay? Some of them might take 5 business days, but they get approved really quickly, okay? Now, the other advantage is that these policies use unisex rates. So women pay the same rates as men. That's a good thing for women, okay? Also, there's lots of choices with caregiver. These policies typically just write you a check. You can do whatever you want with the money every month, and you can hire whoever you want to pay for your care. But the biggest disadvantage to these policies is because they're so easy to get, the insurance companies have lower benefit limits. Okay, you can't buy as much coverage with an easy to qualify for policy compared to the other types of policies. All right. So, so the asset-based policies, there's lots of advantages to the asset-based policies, lots and lots and lots. Okay, they usually use simplified underwriting. Okay, so typically you can just do a telephone interview with a nurse from the insurance company. Maybe it lasts about 45 minutes, 30, 45 minutes. And typically you're approved within 48 hours after that. Okay, so it's usually simplified underwriting. It is guaranteed to pay something. Okay, you're going to get a death benefit. or a long-term care benefit, or if you cancel the policy, you'll get the cash surrender value. Okay, so it is guaranteed to pay something back. And another very common, probably the number one reason people buy, in my experience, that people buy these policies is for the international benefits. The traditional long-term care insurance policies usually only pay benefits for care received in the US or Canada. Okay, for people who want to receive care in other places. Some people want to retire in Guatemala or Taiwan or the Philippines or Spain, whatever. They'll often buy these policies because of the international benefits. And there's lots of choices for caregivers because these policies usually just write you a check every month. You can pay whoever you want to care for you, even family members. And the premiums, another advantage is that the premiums are limited pay. So you usually only pay premiums for a set number of years, maybe 10 years or maybe 15 years. Or with most of these policies, you just write one check and you don't pay anything besides that one single premium. However, there is one disadvantage to the hybrid policies or to the asset-based products, the cost. Okay, they're not cheap. All right, you do have to pay because you're guaranteed to get the death benefit. You do have to pay something for that. So typically, the asset-based products, the asset-based policies are priced considerably higher than a traditional long-term care policy. So let's take a look at how much these policies cost. All right, cost of each type of policy. All right. So let's look at the asset-based policies first. Okay, they're the most expensive. We'll look at them first. Okay, 59-year-old married non-smoker. Okay, and the policy that in this example, $168,000 worth of death benefit in it. Okay, and $750,000 in long-term care benefits. All right, and a 3% compound inflation protection. Now that 3% compound inflation protection is really, really, really important, okay? Because that means that this $750,000 in long-term care benefits is going to double by the time this person is 83 years old, okay? So instead of, so it starts off at $750,000 worth of long-term care benefits, but it's going to double to 1.5 million by age 83, and it continues to grow even after age 83. It'll grow every year for as long as this person lives. Okay. Well, how much does a policy like this cost? Okay. Well, the annual premium for a male for 15 years would be $10,998 per year for 10 years. I'm sorry, for 15 years. Okay. Female would pay more. As I mentioned, women pay higher rates for long-term care policies than men do. Okay. And so a female would pay $13,000 per year for 15 years for these same benefits. Okay. Now, for my clients who buy these types of policies, do they usually buy that much? No, they usually buy a little bit less. Okay, most of them buy maybe closer to $500,000 in long-term care benefits, which would then grow to $1 million worth of benefits by age 83. But this is just one example, just to give you an idea. Now, what about easy to qualify for policies? Well, these are super cheap, okay? Because the benefits are much lower, okay? So a 59-year-old could buy one of these easy to qualify for policies, okay? As long as they're not tobacco, and they could buy $144,000 worth of facility benefits and $108,000 worth of home care benefits with a 5% simple inflation protection that's going to double the benefits by age 84. Okay, and the annual premium for that policy is $23.17. Okay, much lower benefits, much lower annual premium. Okay, now what about traditional long-term care insurance? Well, let's first take a look at a couple. Okay, so we have a 59-year-old couple, okay, who buys a policy that starts off with $1.5 million of shared long-term care benefits. Okay? $1.5 million worth of shared long-term care benefits. Now, some of you are thinking right now, I didn't know that long-term care policies could have that much in benefits. Well, they do. I mean, if you just read the internet, what the internet says about long-term care insurance, they're going to say, well, the average long-term care policy has $165,000 worth of benefits. You know how many policies I've sold that have $165,000 worth of benefits? Zero. None. None. Right? They're available, but they're meaningless in my opinion. Okay. So in this example, a 59-year-old couple could buy $1.5 million worth of shared benefits, a $6,900 starting monthly benefit for each spouse with the 3% compound inflation protection. I put that in red because it's so important. Okay. And their combined annual premium would be $7,458. Now, Scott, do most of your clients buy $1.5 million worth of shared long-term care benefits? No, most of them don't buy that much. They usually buy lower amounts. It all depends upon how much they want to co-insure, okay? How much do they want to co-insure? And again, keep in mind, with that 3% compound inflation protection, by age 83, they'd be sharing $3 million worth of long-term care benefits. And by age 83, their monthly benefit would be almost $14,000 per month. Now, what about a single person? Well, here's two examples. We got a male and a female, both age 59, but they're single, okay? So a single person is not going to get a marital discount from most long-term care insurance companies. But here's a single person buying $500,000 worth of long-term care benefits, again, with a starting monthly benefit of about $7,000, okay? And again, with a 3% compound inflation protection. So that's going to, by age 83, this is going to be, that $500,000 of long-term care benefits is going to be $1 million worth of long-term care benefits, okay? And a male for this type of coverage would pay $3,612 per year, okay? Female, much higher premiums, $5,967. And that's because the actuaries have determined and seen that about 2/3 of every long-term care claim dollar goes to women. Okay. So I hope I didn't take too long there, Scott, but that's what I wanted to cover.
No, that's
what I want to do next is the Q&A. Let's see. All right. Wow. Okay. It took me about 10 minutes longer than I thought it would. So I apologize.
No, that's great. It's really informative. Every time I talk with you, I keep taking more notes. So I appreciate it.
Okay, great. That's good.
So how do you know if self-insuring for long-term care is appropriate for a couple currently in their early 60s?
Well, that's a great question. And my answer to the question is that there's very little upside to self-insuring. Okay. There's potentially a lot of downside to self-insuring. Okay. So, for example, we looked at my mother-in-law. Okay. I mean, her policy resulted in, because of all the tax savings, especially, it resulted in her balance sheet improving significantly over that 4-year period. And somebody, so let's just use real numbers. Let's suppose somebody has invested assets of $2 million, okay, and they decide to self-insure, okay. Well, or if they don't, let's say they buy that policy I talked about, that policy that I'll just round it up. Let's say $8,000 per year in annual premium. Okay. So instead of paying an $8,000 annual premium, let's say that couple keeps that $8,000. How much have they gained? Okay. Their $2 million portfolio has gone up from 2 million to 2,008,000. Okay. In other words, that's about a 40 basis point increase in their net worth. That's not a significant increase in someone's net worth, okay? However, if one of them needed care, that's potentially hundreds of thousands of dollars in care that they'd have to pay for, okay? Hundreds of thousands of dollars, maybe even $1 million or more if it's a catastrophic event, Okay. Personally, my biggest long-term care insurance claim was about $980,000. Okay. One client who got early onset Alzheimer's and he needed care for 11 years, and his policy paid out almost $1 million. And he received all that care at home, except for the last 3 months. But so there's not that much to gain by self-insuring. I mean, would it make sense to alter your asset allocation to risk $750,000 if you're only going to gain 40 basis points each year? I mean, that doesn't make sense, right? Doesn't make sense to take on that risk for the price.
So if someone has 5-6 million or
Right.
and up from there,
Yeah.
And they have enough to self-insure, they're not going to outlive their money, husband and wife. This would then be used with that mindset. You're leaving more to your kids or charities or whatnot. It's kind of a first line of defense, just so that your assets can be more productive to how you want beyond your life. Is that the way you'd look at it?
Well, yes, I would look at it that way. And the okay, let me use another example. If I were to drive my car into a tree tomorrow, okay, and total my car, I could go out and pay cash for a car tomorrow and buy a new car. Now, does that mean I should not have collision insurance? Now, I have collision insurance because it's a good value. Okay. Now, collision insurance was costing $5,000 a year. I wouldn't buy the collision insurance. Okay. But it costs about $50 a month. All right. So for $50 a month, the cost of the collision insurance makes sense compared to the potential loss. Okay. So, somebody with $6 million worth of investable assets, it just makes sense to spend a little bit of that, about 10 basis points, maybe 20 basis points at the most, to get a really good long-term care policy. And then when you need care, that's in place, okay? And you start to use that first. And like you said, Scott, it's a good first line of defense, right? And nobody is going to be arguing over, well, which asset should we liquidate first? Should we sell off the rental property first? Should we sell off, the bond fund first? We don't have to have that argument with all the parties involved. Okay, so anyway.
Now, Scott, so nobody knows when we would have a medical event that would not allow us to qualify for the traditional long-term care insurance. So with that in mind, what would be kind of the early age you'd say someone should really start to give serious consideration to get a policy? And on the other end, at what point is it becoming cost prohibitive? So is it 40 to 70? Is it 50 to 60? So can you just answer that?
It's a great question. And I'm asked that question a lot. And I actually promised to answer that question at the beginning when I said 3 questions. This was one of them that I didn't answer. Okay. The best time to buy long-term care insurance is 1 month before you become uninsurable. Okay. But we don't know when we're going to become uninsurable, right? So then it's really a financial question. Okay. So, I'll have somebody in their 40s say, Scott, should I buy long-term care? Well, let me say this. There are people in their 60s who should not buy long-term care insurance not because of their age, but they should not buy long-term care insurance because they could easily qualify for Medicaid. In fact, about half of the people who are retired in our country should not buy long-term care insurance because they can qualify for Medicaid funded long-term care. All right. So, it's just a financial question. So if I'm talking to somebody who's 45 and they say, Scott, should I buy long-term care insurance? I'm going to say, well, do you have all your other financial ducks in a row? Okay. Do you have good disability insurance? Are you maximizing your 401k contribution every year? Do you have enough term life insurance for all your dependents to be taken care of should you die? All those other things are more important than long-term care insurance. But the closer someone gets to retirement, the more important long-term care insurance becomes, the less important term life insurance becomes, and the less important disability insurance becomes. So the closer you get to retirement, the more important it is to plan for long-term care. Now, if you're, it's pretty hard to find a good value for somebody who's over the age of 70. And it's going to be hard for them to even qualify. Okay. It's going to be hard to find a really good value to justify the cost of the policy if somebody's 70 or older. Okay. It's not to say it's impossible. Okay. I do help people who are in their 70s get good policies, but it's pretty rare. Okay. Because usually they can't qualify. So the best time to buy a policy, Scott, is usually somewhere between 50 and 60. Okay. That's usually the best
And
time.
you helped me this year, and when we were talking about a policy, I'm in good health. I'm a non-smoker, so all the underwriting was good. I'm 57, and so what we talked about was I think it was a lifetime benefit of around $650,000 in
Right.
today's dollars. It would be
Right.
adjusted annually at 3% for inflation, and it
Right.
would give me up to a $300 per day in today's dollars benefit. And if I wanted to save $728 a year, and that was about $4,400 in round numbers, and I could save about $720 a year in premium if I wanted to limit that maximum daily benefit to $250. And so just for the folks listening, that's, for me, personal experience, that's what we did. I also I got 6 years ago a hybrid policy that was a $500,000 death benefit life policy, but that death benefit of 500,000 could also be used for long-term care expenses.
Right.
All of us will need long-term care, but we're all going to die. So that's the idea. You'll still get the death benefit if you never use the long-term care. However, that $500,000 benefit, I had to pay a $10,000 annual premium each year for 10 years. And there is no inflation adjustment. So, it kind of covered it was an expensive way to get the life insurance and not as effective way to get the long-term care. But I wanted to get that policy for a few reasons, just as part of the portfolio. But now I see the benefit of having more long-term care based on all of our conversations, and that seemed to be at $4,400 a year, pretty reasonable. So
right, exactly, and there's also tax benefits too.
Yeah. So would Medicare will not pay for the assisted living facility, but there are triggers in the today's version of long-term care policies that would. Is that correct?
That is correct. Right. Yeah. The best way to understand what Medicare pays for is if it's rehabilitative. Okay. So care that helps you get better, that's the kind of care that Medicare will pay for. For long-term care, what qualifies someone for benefits is if they need assistance with any two of the 6 activities of daily living. So, and those 6 activities, and these are federal guidelines I'm talking about. So this is in any policy that meets the federal guidelines uses these 6 activities. So it says if you need help with 2 of the 6 are bathing, dressing, toileting, transferring, eating, and maintaining continence. So anyone who needs help with 2 of those 6 can qualify for benefits. And the 2 most common that people need help with initially are bathing and dressing. Now, the other way to qualify for benefits under a long-term care policy would be due to a cognitive impairment that's severe enough where you need to be supervised for safety reasons. Okay. So the key there is the safety. All right. And, somebody who's cognitively impaired may not know, might wander into the street or might turn on the stove and burn himself or whatever. So the safety is what would qualify to trigger those benefits. And Medicare is not going to pay anything for that. I mean, if somebody has Alzheimer's, Medicare is not going to pay to help the person with the Alzheimer's because there's no way to fix it. There's no rehab. There's no rehabilitative care to fix Alzheimer's. But if that Alzheimer's patient then falls and breaks a hip, well, then Medicare is going to pay for 100 days in the skilled nursing facility while he recovers from the broken hip. So that's the difference, and it's kind of silly, but that's how our system is.
When going through the medical underwriting to qualify for the traditional long-term care, how far back do the insurance companies look at your medical records?
That is a great question. And it depends, okay? Usually they're only looking back a few years, okay? Maybe up to 5, okay? But you know, if for example, let's say there's a notation in your medical records today that says that you had cancer 10 years ago. Well, that's okay, but it depends upon what stage of the cancer. So if somebody had stage 4 cancer 10 years ago, they might not be able to qualify for a long-term care policy. But generally speaking, most types of cancer, and since I brought it up, are usually not a problem with long-term care insurance. Traditional long-term care insurance companies are not concerned about health conditions that will kill you. Okay? They're concerned about health conditions that will not kill you, that will cause you to continue to need care, or where you'll need functional assistance. So the hardest thing for me to find insurance for is long-term care insurance for is somebody who is a marathon runner, because they got a great heart. They're going to live for years, okay? But they've got really bad knees and really bad hips and really bad feet, okay? And so I think I've had almost every marathon runner declined. So anyway, but yeah, go ahead.
And when you and I were talking about my policy, you brought up that it's got the 3% inflation clause, and then there was an option to even have it go as high as 5%. But that was really a big delta, a really big change in the cost. And in our discussion, it was more worth it for me to self-insure that difference between 3 and 5% than to pay for the 5%. And I was a little surprised when you told me that you felt the 3% for inflation was adequate. And I'm thinking, well, inflation could be more in the future. And you said, yeah, but long-term care costs have not really increased. There was a long stretch where it hardly increased. And there's a difference between that inflation versus the headline CPI inflation or other medical inflation. Can you just talk about that for a moment?
Sure, absolutely. Yeah. Long-term care inflation is based on labor costs. That's the primary factor. So if labor costs are going up, well, then that's going to make long-term care inflation go up. All right. And from 2008 up until about 2019, okay, or maybe 2017, I don't know, we had very low inflation because there was so much unemployment from the mortgage crisis that people were accepting jobs as home health aides or as aides in nursing homes, and even though the pay was not that great, but they needed a job. Okay, so long-term care inflation has been much lower than medical inflation, much lower than the CPI. It did change in 2020, of course. Okay, when COVID hit, well then the cost for care went up substantially. Okay, and so there was a big jump in 2020, 2021, 2022, but it's starting to level off again. So we're not getting those huge jumps like we did. But so yeah, because of the way the policies are priced, I usually recommend the 3% compound. The 5% compound is usually not a good value. Okay, there's a few situations where it is, but it's usually not. It's usually much better just to buy a 3% compound and increase your daily benefit to as much as you can afford.
Going back to that hybrid policy, a discussion I said with my own personal experience. Do you think
Yeah.
today, assuming you medically qualify, you're better off to get a standalone life policy and a standalone long-term care? Or do you see the value today in that hybrid? Yeah.
Good question. I do see the value in the hybrid. Okay. The, um, the, I mean, it's quite a bit more, I mean, so we're looking at that example that I gave of that 15-year premium payments for a 59-year-old male and a 59-year female. I mean, you're talking between if they're a married couple, okay, and we're getting coverage for both of them, that would be about almost $25,000 per year for 15 years to buy those policies for them. Okay. Whereas they could, as a couple, they could get a really rich traditional policy for about $7,000 or $8,000 per year. Okay. So the question is, well, which is the better value? What I default to is the actual benefits. Okay. So if a couple says we're probably going to retire overseas, or we're definitely going to retire, we're going to this country and that's where we're going to spend the rest of our lives, well, then we're going to have to go to the hybrid or the asset-based policy, because asset-based policies have the best international benefits. Okay. Or another example is if someone says we have relatives, our son, daughter, niece, nephew, whatever, who are healthcare professionals. If we need care, we want to pay them. We want to pay a family member. Okay. Well, in that situation, we're going to have to go to the asset-based, because traditional long-term care insurance is not going to pay.
Oh, but the hybrid policy would pay for a family member to care for you?
Yes, exactly. Yes.
Okay.
So there's more flexibility and choice of caregivers with the hybrid. Okay. So yeah, hybrids are more expensive, and whether it makes sense to pay that extra amount depends upon those factors primarily.
That's
Okay?
great.
So,
all right,
yeah.
I got two more questions and then we'll wrap it up. One,
Yeah.
we haven't really touched base on the elimination period. Can you explain what that is and what
Sure.
you recommend?
Yeah, great. The elimination period is essentially a deductible, okay, with no matter what type of long-term care policy you buy, whether you buy traditional or the asset-based, or if you buy just one of the easy to qualify for policies, they all have some type of elimination period, which is elimination period is insurance code word for deductible. Okay, it's a lot easier to just say this is the deductible. So it's the number of days that you would need care before the policy would start to pay benefits for your care. Okay. And so what kind of elimination period I recommend depends almost exclusively on what type of policy we're looking at. First off, with the asset-based policies, we usually do not have a choice. The asset-based policies usually say, this is the deductible, period, or this is the elimination period. And there's nothing we can do about it. We can't change it. With the easy to qualify for policies, we usually can change it. And I'll compare. I'll say, well, is it, how much of a savings would we get if we did a 100-day elimination period rather than a 20-day, or rather than a 0-day? Okay. So I'll compare those for each client to see if it makes sense, if it's worth it to get the short elimination period based, with the cost, if the cost justifies having that benefit faster. And then with traditional, it all depends upon the company. There's some companies that give huge discounts for a 180-day elimination period. Okay. And most of my clients are on the fence between self-insuring or buying a policy. Okay. Well, if you're comfortable, if you're intellectually comfortable self-insuring, well, why not just, self-insure for 6 months, for 180 days. Okay. Self-insure that portion and then co-insure maybe the rest of your care after that. So in some of the traditional policies, I'll recommend a 90-day elimination period, only because there's very little savings if we go from 90 to 180. Okay. So again, it's all going to boil down to which company are we looking at, and what does that company give a big discount for a longer elimination period. If they do, I'm probably going to recommend that.
Okay, great. And one last question. So there's in the policy, traditional long-term care, there's a daily maximum benefit, and then there's a lifetime maximum benefit, but that benefit will go to the end of your life, assuming you haven't used it all. Is that correct? I mean, so it's not, it doesn't, oh, this policy is good for this amount of money up until age 95 or 100 or 100. It goes with you until you're no longer here, right?
Well, right, or until you've exhausted all the
All the-
policy
Yeah,
benefits, right? So my mother-in-law, for example, when she bought a policy that was 3 years, okay, it had 3 years of benefits. Well, she actually needed care for 4 years, okay, because she hadn't exhausted her benefits. She hadn't used up all the benefits in the policy. So her 3-year policy lasted for the 4 years that she needed care. And when she died, she's had about 75,000 still in the policy. So her 3-year policy would have lasted over 5 years, okay? But because they're going to go, the company goes by the policy limit, what's called the pool of money or the pool of benefits.
I see. Oh, but and just one last thing about that when you said your mother.
That's okay.
So you said she went to attend some family weddings.
Yeah.
Did she get long-term care assistance for that travel, or while she was on location there? Or how did that work?
Yeah, we could have done that, okay. But basically my wife was her home health aide, okay, for during that travel time. And actually, the policy that she did have at that time had changed their rules. They made their rules more liberal. During COVID, some of the companies said, we normally don't pay family members, but because there's so few home health aides now, and because everybody's looking for home health aides, we're going to pay family members to provide care. So my wife actually got paid to provide some of her mother's care from that policy.
Okay, great.
Yeah.
Well, Scott, thank you very much for your time. Like I said, I wrote a lot of notes, continue to learn every time we talk. I've read your books. We've talked a bunch of times, and always very interesting. So thank you very much. Hope everybody enjoyed this. We should have this up on the website for review or sharing sometime probably later tomorrow. Just takes a little time to get it all uploaded, but yeah, it'll be there. So anyway, Scott, thank you very much. I appreciate your time today, and thank you everybody for attending.
Thanks, Scott.
Take care. Bye-bye.